everybody. So welcome everybody once again, and I hope we've got rid of the echo. Let me tell you a little bit about BDO for those of us who may not know BDO. BDO is a global audit and advisory firm. We're actually the 5th largest in the world. I mean, everybody's heard about the Big Four. We're number 5, and not by very far. Last year, we had revenues of $12.8 billion worldwide. We have a presence in 164 countries and territories across the world. So we nearly have a complete global footprint with 1,803 offices across the globe and over 111,000 professional staff. You can see the areas shaded in the map, and everything that's shaded dark gray is where BDO has offices. Our services, we provide all the traditional services expected of an advisory and audit firm, such as audit and assurance, statutory audits of financial statements, audit of donor funds, and also special purpose audits. We do internal control audits. We also provide outsourced internal audit, internal control, internal audits. And then we provide specific training on stuff like IFRS, technical assistance, accounting standards, and so on and so forth. We have a taxation department which provides tax compliance services, tax advisory services, tax audits, and health checks, transfer pricing. Specifically, we have a transfer pricing webinar tomorrow. So please let your financial people and people who are responsible for tax and also for strategy to know, because that's going to be a very exciting event. That's tomorrow afternoon, led by our partner, Steve Okoth, tax partner, Steve Okoth. So don't miss that one, inform everybody. And then we provide employment tax and expatriate tax advice, and we also provide tax opinions. And then there's advisory services, which is where I sit, and I head the risk advisory division, which comprises internal audit and risk management. I've also done a fair amount of managing consulting in my time. And I also head the corporate recovery and restructuring division. At the moment, I'm also looking after corporate finance and transaction services, which is why I'm playing host today. And then we provide fraud investigation and forensic services. And we also provide IT and technology advisory services. BDO is a global market leader in corporate finance, which is today's topic. And some of you might know this. We completed 2,095 deals in last year, 2022, with a total deal value of $114 billion. That's not a small number. 38% of those were private equity deals, and 26% of those were cross-border. So you can see we're very active globally. We have 2,500 full-time corporate finance professionals based in 120 countries. And we're first in many, many things globally. So in 2022, we were the first financial advisor globally in the FactSet League tables. The year before that, in the PitchBook League tables, we were the first in the category of most active advisor and accountant globally in 2021. And again, in 2022, Merger Market Global Accounting League tables, we came second as the leading financial due diligence provider globally. So yeah, BDO is known for making deals and helping clients make deals. Let's talk a little bit about what we're here to discuss today. And I'm really thrilled to be with you today to discuss a crucial aspect of the business world, which is the intricate art of securing external capital through the investment process. The investment process is a series of steps that commences with meticulous planning, and it culminates in what we term financial close. This is when financial commitments are legally bound to a business a special purpose vehicle, or a project account. The fascinating aspect of the investment process is its adaptability. It's not a one size fits all scenario. Rather, it depends on a variety of factors, such as number one, the type and source of funding sought. Number two, the timelines in play. And number three, the current stage and track record of a company. For instance, when we talk about a startup embarking on a fundraise, the focus naturally gravitates towards the market potential and the background of the team. It's about the promise and the potential of the business and the key information provided that holds the key to success. In contrast, asset or trade finance can be matched to contracts or underlying assets. Here, the goal is to often raise debt against these assets with the rates and tenors determined by the associated value and risks. Moving on to mergers and acquisitions, or M&A, this involves another company, often referred to as a strategic investor, taking ownership, whether in full or part, of the acquiree company. Here, we are identifying synergies and long-term added value that the two companies can achieve through mutual collaboration. Then there's the financial investor process. Here we're talking about securing investment from institutional investors in the market. Typically, these investors seek established companies. Occasionally, they may seek greenfield deals from seasoned promoters, because these may also be of interest to them. But this series of webinars, the ones we're having now, part 1, part 2, and part 3, these will center around the financial investment process. So different financing needs arise across a business's life cycle, and understanding the unique financial needs at each stage of a company's life cycle is vital for strategic decision making. The need for various types of investors and investment products will evolve as the company grows. And this alignment of financing strategies with the specific demands of each phase in a company's life cycle is what contributes to sustained success and continuous growth. So let's delve into these stages and discuss some of the unique financing requirements, the type of investors, and the investment products associated with each type. So let's start with the startup stage. And what are the characteristics here? So here at inception, we're talking about the establishment of the business. And then you're developing products. Those are at a development stage. So you're creating and you're testing the market with your products or services. In terms of revenue, there's limited revenue. And generally, businesses will even operate at a loss. And then there's the, what are the financial needs at this point? So basically, such a business is going to require seed capital, initial funding for product development, for market validation, and they'll also require working capital to cover early operational expenses. Who are the type of investors that might be interested in this kind of business? We're looking at angel investors. These are individuals that provide early stage capital. We're also looking at venture capitalists, and these are investment firms focusing on high growth potential. And some of the investment products that will be suitable at this stage are equity financing, which is issuing shares in exchange for capital. This is normally done by the business owners, or convertible notes, which is short-term debt that is converted to equity, with the passage of time. Next, we can move on to the proven products stage. Now, what are the characteristics of this? Well, first of all, this is when there's market validation. So you're looking at proven demand for your product or your service. And also you start generating revenue. There's sales, you're building up your customer base, and the business is starting to take foot. Now, what are the financial needs at this particular point? So you're scaling operations, you're expanding production, you're increasing your marketing efforts, and you require working capital to support the increased demand for your products and services. Now, what are the kind of investors that are going to be interested in your business at this particular point in time? It's going to be venture capitalists, again, continuing from the startup stage. It's also going to be private equity firms that are seeking opportunities for growth. And the kind of investment products that you should look at is equity financing by issuing more shares, and also mezzanine financing for expansion. Next, we move on to the high growth stage. And the characteristics here typically will be significant increase in revenue and market share, and also geographical expansion, entering new markets and introducing new products. What are your financial needs here? So because you're expanding your market, you will need capital to go into these new territories and new markets. And you're also going to be spending more money in research and development, as you innovate new products and new services, trying to capture more market share. So the kind of investors that you need to look out for would be strategic investors who are looking for high returns, private equity firms again, and also strategic investors. These will be in the form of companies that are looking at your business because they can find some commonality and some synergy in what they're already doing. So they will be interested. And the kind of products will be private placements, either direct sale of securities to investors or further issuing of shares. Then you're looking at the next stage, which is your strategic investment stage. And here you're looking at strategic partnership opportunities through collaborative ventures. You're looking at diversification in terms of entering new lines of business with new products or new services, or complete diversification into something that's related and still different. And then you're going to have what are your financing needs? So you'll need capital for partnerships, for diversification. You're going to need to invest in technology, staying competitive through constant innovation to stay ahead of the market. Now your market share has grown and you're trying to capitalize on this. So the kind of investors who are going to be interested will be strategic investors, corporations who are seeking partnerships, and also private equity firms, because these will bring to your table industry expertise. And the kind of investment products that you might want to look at will be joint ventures, collaboration on various projects with shared resources. And then at the last stage, really, which is where you're ready for capital markets and for a IPO, here your business is mature, you have established market presence, you're very profitable, you've got a consistent track record of revenue and profit generation, and you've got the numbers and the audited accounts to back it up. So here you're basically preparing for an IPO. This will require legal work. It requires financial preparation, getting all of your books into order, getting your group, your structure, and everything else into order. And also, you're going to need finance to expand into new markets, because now you're really running, you're up and running, and you're flying actually. And you're going to have strategies for regional growth and even for global growth. So the kind of investors you're going to be looking at here are large-scale investors, such as mutual funds and pension funds, and also private equity firms, especially when you prepare for the public offering. Now let's look at the type of instruments that funders provide. The Africa market is rich with diverse investment instruments, and companies must carefully evaluate these options to align their financing strategy with their growth objectives. Whether you want to attract private equity, engage in mergers and acquisitions, or you're simply exploring blockchain through ICOs, the right choice depends on the unique needs and aspirations of each business. So let's go through each category of financing options, beginning with equity. So shareholders' equity, I think everybody knows this. This is the funds from the owners. It needs no explanation. The next one is private equity funds. PE funds, these pool capital from various investors to acquire, invest in, or provide financing for companies. These funds will often target businesses with growth potential and will work closely with management to enhance performance with the goal of achieving a profitable exit. And then the next category is venture capitalists. Venture capital investors, they focus on early stage companies with high growth potential. They will inject capital into startups in exchange for equity, providing not only financial support, but also providing mentorship and strategic guidance to help these companies scale up. The next category is development finance institutions, or DFIs. These play a crucial role in fostering economic development. They provide long-term capital for projects and businesses that contribute to social and economic progress. DFIs often focus on sectors such as infrastructure, healthcare, and education. And then you're looking at mergers and acquisitions and strategic acquirers. Strategic acquirers, typically, these will be existing companies, and they will invest in or acquire other businesses to achieve synergies. They will want to expand their market presence or diversify their offerings. And then there's issuance of other class of shares and share swaps. Companies may issue different classes of shares, each with distinct rights and privileges in order to raise finance or capital. Companies will also share swaps involving the exchange of one class of shares for another for strategic restructuring or consolidation of ownership. And lastly, there's the listing on the capital markets to raise capital by issuing shares to the public. This enables companies to fund expansion or to repay debt that they might have incurred at the initial stages or pursue other strategic initiatives. And then we're currently living in the era of digital innovation. So initial coin offerings have emerged as a novel way of blockchain-based projects. And these are to raise capital directly through the digital market. So investors will purchase tokens issued by a company, providing them with access to the project's products or services. The next category of instruments funders is mezzanine. Now, mezzanine financing occupies a unique position between debt and equity. These instruments provide a middle ground that balances risk and reward. Let's look at what's available here. So you have warrants and options. These are financial instruments that provide the holder with the right, but not the obligation, to buy a specific quantity of a company's shares at a predetermined price and within a set time frame. This adds a layer of flexibility for the investors, thereby enabling them to benefit from potential future increases in the company's valuation. The next category is mezzanine debt with a right to convert. Now, mezzanine debt sits between traditional debt and equity. It offers higher returns than conventional loans. And in our case, mezzanine debt comes with a right to convert into equity under specific conditions. This convertible feature provides investors with the opportunity to participate in the company's success beyond the fixed interest payments associated with debt. The next category is convertibles, and this is with defined liquidity events or SAFE notes, which stands for Simple Agreement for Future Equity. Now, convertible instruments allow investors to convert their debt or notes into equity at a predefined conversion ratio. In addition, SAFE notes are a form of convertible instrument commonly used in early stage funding rounds. They provide a straightforward agreement for investors to convert their investment into equity at a future financing round or at specific liquidity events. The next category is quasi-debt or quasi-equity instruments. These instruments blur the lines between traditional debt and equity. They might include revenue-based financing or income-sharing agreements. Here, investors receive a return based on the company's revenue or profits, resembling debt-like structures or debt-like characteristics, yet with an equity-like participation in the company's success. And then you've got profit participation rights. Now, profit participation rights provide investors with a share in the company's profits. Unlike traditional equity, where investors participate in profits through dividends or capital gains, profit participation rights specifically link returns to the company's profitability. This allows investors to share in the financial success of the company without necessarily holding any equity. Now, the next category is debt, which we're all familiar with. Debt financing is another avenue to support companies through their journey when they're growing and also through sustainability. Let's look at some of the key instruments within this. So first of all, there's going to be corporate bonds. These are debt securities issued by companies to raise capital. The bonds typically have a fixed interest rate and maturity date. Investors who purchase these bonds are essentially lending money to the issuing company in exchange for periodic interest payments and the return of the principal amount at maturity. So corporate bonds offer a reliable source of funding for companies which are looking to expand operations or to finance specific projects. The next category in debt is convertibles, and convertible securities offer a hybrid solution. This combines the features of both debt and equity. In the case of convertible bonds, investors initially receive fixed interest payments. However, they have the option to convert their bonds into a company's equity at a predetermined conversion ratio. This provides investors with the potential for capital appreciation while offering the company a source of debt financing. Now, the next category is specialist lending. Specialist lending encompasses a variety of tailor-made financial products designed to meet specific financing needs. This category includes things like loans with unique terms and also things like equipment financing or project financing or other specialized lending agreements. These instruments are crafted to address the distinct requirements of companies operating in various industries, and they can be made specific for each industry type. And then you've got shareholders' loans. These occur when a company borrows funds directly from its owners and shareholders. This form of debt financing is often used in closely held or family-owned businesses. And shareholders' loans are usually more flexible compared to traditional loans because they represent a way for shareholders to contribute to the company's financial needs while maintaining a vested interest in its success. And then structured finance, which is one of our fortes. This category encompasses a range of innovative instruments that go beyond traditional debt and equity, and it offers tailored solutions to meet the diverse needs of companies as well as projects. Let's look at some of the key components of structured finance. So starting with sale and leasebacks. These transactions involve a company selling its assets, such as real estate or equipment, and then leasing them back from the buyer. This financial maneuver allows companies to unlock the value that's tied up in their assets, thereby providing an injection of capital while still maintaining control. The next one is factoring, and accountants will know this. Factoring is a financing method where a business sells its accounts receivable to a third party, known as a factor, at a discount, and sometimes at a huge discount. This enables companies to convert their receivables into immediate cash to improve their liquidity, and also to mitigate the impact of delayed payments. And then there's inventory-backed finance or warehouse receipts. Inventory-backed finance involves using a company's stock as collateral to secure a loan. Warehouse receipts, which represent the ownership of stored goods, these are the ones that serve as the basis for this type of financing. And what does it do? It allows a company or a business to access capital whilst still using their inventory and providing that as security. And then the next stage is securitization of collateralized debt obligations, or CDOs. Securitization involves bundling various debt obligations into tradable securities, such as collateralized debt obligations, or CDOs. These instruments, what they do is they pool diverse assets, things like mortgages or corporate debt, and they provide investors with exposure to a portfolio of financial instruments. And then you've got the last category in structured finance, which is project finance, which is PPT or public-private partnerships, BOT or build, operate, transfer, HAM, which is hybrid annuity models, and also special purpose vehicle financing. Now, project financing involves financing of specific projects through these structures. And the structures enable companies to fund large-scale projects with long gestation periods, such as infrastructure development projects or energy projects. And what they do is they allow risks to be mitigated, and they also involve multiple stakeholders. And then there's another category which we've put under others, and these are equally impactful methods. So let's look at each one of these. Let's start with concessional funding or grants. Now, unlike traditional loans, grants do not require repayment, and this makes them an attractive option for various entities, including businesses, not-for-profit organizations, and research institutions. These funds are typically provided by government agencies or specialist foundations or philanthropic organizations with the aim of supporting specific projects, fostering innovation, or addressing societal challenges. So grants serve as a catalyst for initiatives that may not immediately generate financial returns, but they contribute significantly to social, to environmental, and also to cultural objectives. They allow businesses and organizations to pursue projects that align with their mission without the pressure of immediate financial repayment. And then there's crowdfunding. We live in an era of digital connectivity, and crowdfunding has emerged as a powerful and accessible way to raise capital. This method involves reaching out to a large number of individuals, often through online platforms, and encouraging them to contribute small amounts of money to a fund to fund a project, a product, or a business. So, I mean, these are the numerous types of instruments that we've just gone through. Now let's turn to investor types. And it's crucial here to recognize the diversity among investors, each with distinct needs and preferences. So let's start with international lenders. And just to picturize this, you can use the example of Standard Chartered. Now, international lenders operate in multiple jurisdictions, and hence they play a pivotal role in providing financial support across borders. A prime example is, as I've said, Standard Chartered, which is a renowned bank. It has a strong global presence and a substantial footprint in Africa. So here are the key aspects of international lenders. First of all, they provide diverse services, including financial services such as debt financing, trade financing, and treasury services. Their global reach allows them to facilitate cross-border transactions and to support businesses in navigating complex international markets. The other characteristic is risk mitigation. International lenders such as Standard Chartered Bank, often bring expertise in managing risks associated with cross-border transactions. They leverage their understanding of various markets, and they assist businesses in mitigating currency risks, regulatory challenges, and other complexities which are inherent when you're dealing with cross-border and international operations. And the other characteristic is corporate banking. So you'll find they actively engage in corporate banking, and they provide tailored solutions for businesses of various sizes. They'll provide products such as working capital financing, project financing, and also advisory services, advice to support businesses in achieving their strategic objectives. The next category is specialist lenders and grantee funds. And here we have the example of MIGA, the Multilateral Investment Guarantee Agency, a member of the World Bank Group, as many of us know. Now, specialist lenders and guarantee funds cater to specific needs within the market, and they offer targeted financial solutions. Let's explore how they do this. So first of all, through focused financing. Specialist lenders concentrate on niche areas such as trade finance or microfinance, or they target specific industry sectors. MIGA, as a guarantee fund, focuses on providing political risk insurance and credit enhancement to encourage foreign direct investment, FDI, in developing countries and in Africa. And the other thing is risk mitigation. Guarantee funds such as MIGA play a crucial role in mitigating political and sovereign risks. They provide assurances to investors and lenders, making it more attractive for them to participate in projects in regions where political and economic uncertainties might otherwise pose challenges. And that's why this is so important in our region. And then also they support development goals. Many guarantee funds, including MIGA, align their activities with broader development goals. By facilitating investments in critical sectors, they contribute to economic growth, to job creation, and to the overall development of the countries that they operate in. The next type of investor is mezzanine funds. And here we can use the example of Ethos Capital. Now, mezzanine funds are a distinctive category of investors that specialize in providing mezzanine type financing instruments. Let's look at the key aspects that define the significance of these players. So first of all, it's hybrid financing solutions. Mezzanine finance, as we've already said, it sits between traditional debt and equity. And these funds excel in crafting hybrid financing solutions. They offer a flexibility to businesses. Their solutions will typically include a mix of debt and equity features, and they allow for tailoring of various financial arrangements. Mezzanine finances funds, they also provide a flexible capital structure, and often this will involve subordinated debt or preferred equity or other financial instruments that adapt to the specific requirements of the investment opportunity. This flexibility can be particularly advantageous for companies seeking a financial solution that aligns with their growth plans. And the other thing is balancing of risk and return. So what mezzanine financing inherently does is it involves a balance between risk and return. Investors in these funds, they typically seek higher returns than traditional lenders, but they're willing to take on a level of risk that is lower than pure equity investors. And then there's also supporting growth and expansion. You'll find mezzanine funds play a crucial role in supporting businesses during their critical phases of growth and expansion. This, in turn, contributes to unlocking value in those companies, and it enables them to pursue strategic initiatives, acquisitions, or other value-creating projects. And the last component here is exit strategies. Mezzanine funds are strategic in their approach to exits, and they will often participate in the success of the companies they invest in through mechanisms like equity kickers or warrants, which align their interests with the long-term success of the business. So what's an equity kicker? It's basically an equity investment where the lender provides credit at a lower interest rate and in exchange gets an equity position in the borrower's company. An equity kicker is structured as a conditional reward where the lender gets equity ownership that will be paid, but at a future date when the business attains specific performance goals. Equity kickers are typically used with leveraged buyouts, LBOs, with management buyouts, MBOs, and also with equity recapitalizations. Such transactions are considered too risky to attract additional and traditional forms of debt. Therefore, mezzanine and subordinated lenders will use equity kickers to compensate them for the increased risk of lending to companies with insufficient collateral for loans. And the next category is strategic corporate investors. And here I want you to think of Procter & Gamble as an example. Strategic corporate investors bring a unique blend of financial acumen and industry expertise to the investment arena. Procter & Gamble, as we know, it's a multinational powerhouse. This serves as a good example, and here's how they do it. So the first thing is long-term synergistic perspectives. They take a long-term synergistic perspective, unlike traditional or certain investors who have a short-term focus. Strategic corporate investors, they approach investments with a long-term vision. Their strategic perspective goals, and their goals go beyond immediate financial returns. They will emphasize synergies that can be unlocked over time. And this often involves aligning their investments with the broader objectives and growth strategies of the companies that they will target and they will invest in. The next key area of how they do it is financial instruments between debt and equity. So strategic corporate investors often utilize financial instruments that bridge the gap between traditional debt and equity. These instruments carry a higher risk appetite than pure debt, but involve less risk and ownership. And we've just talked about the equity kickers. This allows them to participate in the growth of an investment company whilst balancing their exposure risk. And then there's also the aspect of strategic investments through mergers and acquisitions. Strategic investors frequently engage in M&A activity as a means of expanding their market presence or gaining access to complementary technologies and capabilities. And here we can see Procter & Gamble, they have a history of strategic acquisitions globally, and this is how they've enhanced their product portfolio and also their global reach. This approach goes beyond financial investment and involves active participation in the strategic direction of the investment company. And the other thing they do is industry expertise and value addition. You'll find strategic corporate investors bring not only financial resources, but they also bring industry-specific expertise. Their involvement will go beyond providing just the capital. They actively contribute their insights, their best practices, and they also provide operational support. This collaborative approach aims to create value for both the investor and the invested company through knowledge transfer and through operational synergies. And then the other aspect is global reach and market access. We know multinational strategic investors, again, thinking of Procter & Gamble, they often provide companies they invest in with access to global markets. And we know this can be a game changer, particularly for businesses here in Africa, opening up new opportunities for expansion and for internationalization. Then we can look at financial equity and debt investors. These investors operate with a focus on financial returns, and typically they have a medium to long-term investment horizon, typically spanning 5 to 7 years. Their primary goal is to achieve attractive financial performance from their investments. And some of these examples are DFIs or development finance institutions. Key examples will be the British International Investment, BII, or for PARCO, that's the French pronunciation for people who know it as Proparco, but it is Proparco. So DFI institutions, these are state-affiliated investors with a mandate to promote economic development. They are often donor-funded, and they play a crucial role in supporting projects that contribute to sustainable development goals. The next category is regional development banks, and there's the example of Africa Development Bank and also Trade and Development Bank, or TDB. Now, regional development banks, these are multilateral investors with a focus on regional development, regional economic development. And they operate across multiple countries, and they support projects that have a broader regional impact. And then there's private equity. And again, you can take examples like Acumen, like Catalyst. Private equity firms, we've just talked about it, they're equity investors. They seek a more mature, high-growth opportunity. And they will actively participate in the management and in the strategic decisions of the company they invest with, because they are aiming for substantial returns. And then there's another category, which is impact investors. And here we can think of Novastar. So impact investors, they prioritize both financial returns and also positive social or environmental impact. So Novastar, for instance, focuses on businesses that align with specific impact goals, ensuring that their investments contribute to positive change wherever they invest. And then you've got venture capitalists such as Entler. Venture capital firms are early stage investors. Particularly, they look for high growth opportunities, often in technology or disruptive products sector. Entler, as an example, supports startups during their early stages and provides crucial funding and also mentorship. And then you've got concessional financing. Concessional financing emphasizes social impact and community development over conventional financial returns. Unlike many traditional finance investors, foundation and donor grant providers such as MasterCard, Foundation, they're not primarily seeking financial returns on their investments. Their motivation lies in creating positive societal impact and addressing specific challenges faced by communities. And then you've got also, for concessional financing, their primary goal and their primary focus is to bring positive change and to address societal values, whether it's promoting education, healthcare, or economic empowerment. You will find the MasterCard Foundation and similar organization, They prioritize projects that align with their core mission, and they have a tangible impact on people's life. Concessional financing often supports smaller scale initiatives that might not attract significant attention from traditional investors. This approach ensures that grassroots projects and local enterprises receive the support needed to thrive and to contribute to community development. And also, foundation and donor grant providers typically have flexible funding criteria. This allows them to adapt to the unique needs of the projects they support and to engage in a diverse range of initiatives, and also to respond to emerging challenges in real time. And lastly, capacity building and collaboration. Beyond financial contributions, you'll find foundation and donor grant providers will engage in capacity building and collaborative efforts. They work closely with local communities, with NGOs, and with other stakeholders to ensure that projects they support have sustainable and lasting impacts. Next, let's look at stakeholders in the investment process. And here, a number of actors come into play when looking at transactions. And what's important is to understand the roles of these key players, because once you've understood that, you get a holistic view of the transactional process. So at the forefront, we have the investor side. They are the financial and strategic architects of growth. Whether individuals or institutions, they bring more to the table than just capital. They inject vital expertise, experience, and often a network that propels the company forward. Beyond being just financial backers, these investors become strategic partners. They actively engage in the trajectory of the business, and they contribute not just funds, but also insights, guidance, and a vested interest in success. On the opposite side, we find the seller side, representing the company seeking investment. This side is a master negotiator. They work diligently to structure a deal that not only meets their immediate needs, but also maximizes the overall value of the enterprise. Sellers navigate a complex terrain because they have to balance the financial considerations with the strategic direction of the business. Their goal extends beyond the immediate transaction. It involves securing a foundation for sustained growth and prosperity. And lastly, we've got other stakeholders. These are the specialized professionals and entities that ensure that the transaction is legally compliant and financially sound. So lawyers will deal with the legal complexities, accountants will scrutinize the financial health of the business, and compliance experts ensure adherence to regulatory standards. Collectively, these stakeholders form the backbone of a transaction, providing the necessary checks and balances that safeguard the interest of all parties involved. Now let's look at the investment process. And basically, this is the focus of the next part of our talk. So we're going to talk about the preparation phase. And the preparation phase is actually the cornerstone of a successful investment process. It's the stage where the foundation is laid and each component, planning, financial modeling, deal structuring, and the data room, all of these components, they play a pivotal role in shaping the narrative and the attractiveness of the investment proposition. And in a few minutes, my colleague Sajan is going to come and spend the rest of the session just taking you through the preparation phase. So basically, let's go very quickly through the other phases, which is the investor engagement stage. And I'm briefly going to talk about this because this is now it's just a taster. This is what our next webinar is going to focus on, and also negotiation and execution close, which is what our last webinar is going to focus on. So the investor engagement stage, this comprises the preparation of a teaser and information memorandum. These documents, they are the ambassadors of your business to the investment community. The teaser offers a snapshot, like a tantalizing glimpse, which is going to spark interest. On the other hand, your information memorandum, this is the one that delves deeper. It provides a comprehensive overview of the business, its markets, its financials, and also its growth potentials. Crafting these documents, I must say, it's an art, and it's a delicate balance between being brief and also showing substance. So getting this right is really important, because that is what's going to make the deal work. The next one is investor mapping. Investor mapping is about identifying and targeting the right investors for your venture. This involves understanding their preferences, risk appetites, and strategic interests. It's a strategic exercise, and it ensures that you're presenting your investment opportunity to those who align with your vision and those who can contribute meaningfully to your business. So effective investor mapping, it sets the stage for a more focused and productive engagement. The next one is presentations and initial discussions. So now your documents are ready and your potential investors have been identified. So the next step is to showcase your business through presentations and initial discussions. This is now your time to shine. So your presentations need to be clear, they need to be compelling, and they need to be tailored to your audience. It's not just about conveying information. It's about creating a narrative that resonates with your targets, your target investors. These initial discussions, they are going to lay the foundation for building relationships in the long term. And they provide an opportunity to address questions, to gauge the interest, and to start forming a connection between your business and your potential target investors. And the next stage is negotiation. This is a back and forth where both parties work towards aligning their interests. So there's the due diligence. This is the investigative phase where potential investors, they will scrutinize every aspect of your business. So be prepared for this, from financial projections to operations to the legalities to market positioning. Due diligence leaves no stone unturned. It's a rigorous process. It's aimed at validating the information that you've presented. They will assess your risks, and they will ensure a clear understanding of what is on the table. Then you have indicative offers. As the due diligence process unfolds, your potential investors may present indicative offers, and when they do, you can clap for yourself. These are preliminary proposals outlining the terms under which they would consider investing. And indicative offers, they will also provide a framework for negotiation, and they will offer some insight into how your investors perceive the value of the business and what they expect in return. So if you get a low offer, you go back and you look at your initial presentation, and if you get a fantastic offer, then you've obviously presented the bride very, very well. And then you've got initial meetings. These meetings serve as a platform for more in-depth discussions and to further clarify expectations. They also address any outstanding questions, and they explore potential synergies that could arise should a partnership form. And then you've got site visits. Now, numbers and documents, these only tell part of the story. We all know this. So site visits allow potential investors to witness your operations firsthand. Prepare for it. This is when you're unveiling the bride. It's an opportunity for them to assess the tangible aspects of your business, to understand your workplace culture, and to gain insights that may not be evident on paper. Site visits are a very powerful tool in solidifying your investors' confidence and in building trust. This can actually get them over the line. And then you're going to have term sheets. These are the formal documents which outline the terms and conditions of the proposed investment. They will serve as your foundational agreement and they will detail the various aspects, such as how much is going to be invested, what's the valuation, what is the governance structure, and any other specific conditions that must be met for the deal to proceed. And then finally, you've got your execution and close stage. Execution and close, they represent the culmination of all your hard work. Final offers will refine your terms, your sale and purchase agreement, if it's equity, or your loan agreement, if it's debt. These formalize the commitment from the investor, and the closing of the transaction. This signals the realization of your investment journey. So it's not merely a transaction conclusion, it's actually the commencement of a new chapter where your plans and your promises, they materialize into tangible results. So guys, you have a lot to look forward to in webinar episode number 2 and episode number 3. Please be sure to log in again and invite all your acquaintances who you think this will be of benefit to. What I'm going to do now is hand over to Sajan. Sajan is going to be covering the differing priorities of investors and investees, because these do differ. He's also going to be taking you through management considerations for the process, basic tips for first timers seeking external capital, and also the intricacies of the preparation stage. So, folks, over now to Sajan. Sajan, the stage is all yours.
Thanks, Zaire. Let me start sharing my screen so we can continue. And good afternoon to everyone else. Pleasure to have you on board. And let's look forward to the last remaining sessions for today, and we can then take questions after that. Okay, so let me start off looking. So whilst we wind up the overview or guidance of the investment process, I'd like to now, for last few slides, just to go through some of the issues. So the differing priorities for both investors and investees. And it is worth considering the different preferences and the priorities of the company and the investor when you're going through this investment process. And often it's the financial advisors that often help bridge this gap. So investors and companies, always those that are looking to raise money, will each have their own concerns, preferences, priorities, and these need to be aligned for a deal to close. When these are not resolved, deals usually fail, and this is quite an often case in a majority of the number of deals that anyone does work with. So let's look at the concerns that are there from a typical investee perspective. And if you notice, all the concerns are based on the core structure, the rights, and the downside risk management. So from an investee's point of view or the concern, the issue with the core structure is they are looking for cheaper financing. They want loan tenors to be much longer so that they have sufficient time to pay off their debts, but also have easier terms and covenants where there are not a lot of guarantees or personal guarantees involved. Collateral is limited, but generally these are the terms that need to be negotiated from a structuring point of view. On the other hand, from an investor's point of view, an investor is always looking for a higher return. Shorter term allows for better time value of money in terms of their returns, increases the returns again, and that's where they look at higher returns. But they also want covenants that are legal and that are existent within what they look at. So covenants would include some of the conditions that they would look at. If you're looking at from a debt point of view, they're looking at certain ratios. Do they meet and cover their security or their guarantee of retrieving their funds back? Let's look at it from the rights point of view, right? Investing companies are always looking to hold on to control unless there's a different strategic path of an exit or partial exit. So they're always looking for someone who will be more of a silent partner. We talked about the earnout kickers or equity kickers, but kickers basically assist the investee to then recover additional funds or increase the value of the business based on key performance indicators over the next few years. Then you have the issue of freedom of governance, so that they are allowed to make those strategic decisions. Again, ties back to the loss of control from an investor's point of view. From an investor's point of view, they're always looking for some sort of transparency and control over their cash flows. They would want to see that these are imminent and they would be receiving the same back. Enhance a good or implement a good governance structure so that the risk is mitigated, especially from a control and decision perspective, but also have different sort of issues and step-in clauses where they could jump in if required, receiverships, covenants, and contractual rights. So how do people or how do investees manage this downside risk or the downside risk in this term? So we're looking at personal guarantees, not ensuring that there are no personal guarantees, especially from a debt perspective. And the benign terms for the restructuring from a strategic intent. They're looking at enhancing the technology and expertise. Again, this is why they're looking at investors that will provide some sort of strategic insight or assist in developing the business further from a governance perspective and a strategic perspective. And brands and introduce new brands and products. From an investor's point of view, the downside risk management, of course, they're going to ask for collateral and security. Typical case for lenders or debt lenders. But then they're also looking at having guarantees and insurances. So this is where we have the likes of MEGA coming in, which might be a requirement of several different investors, especially from a DFI perspective, that is putting in money that want to have some sort of political insurance covered. And then what is the strategic intent behind this, right? The idea is for them to access different markets, ensure distribution, they're able to get distribution and the sales services, and the management of local conditions. So let's move on to some of the considerations that need to be taken on by the management during this investment process itself. And you'll see quite a few similar phases: preparation, financial modeling, deal structuring, how do you engage with investors, the negotiation and execution close. The timelines you see on screen are typically for a shorter process. This is when everything has been done to the best of everyone's abilities, and there's less complications within the transaction. And you can see the timelines as I could take over time, but these can vary over time. So let's start with the preparation phase, and this involves the build-up of your historical performance and tidying up your financial statements where required. You need to start putting in the governance structures or plans for the business and setting up corporate structures and transaction parameters. A good governance structure upfront can improve the valuations of the business and have a better chance of success when coming to a deal closure. There are other factors to be considered, and you need to consider and prepare for the impact. Prepare for impact in the society, but also look at other ESG issues, especially mitigating all the sector red flags that may be present in the operations. The next point is to ensure that the marketing material is prepared and that clearly highlights the company operations, the past performance, what are the key drivers of growth, and where does this business aim to be over the next few years. So preparing a detailed and organized data room is also easy for investors to access, and this will allow them to have the access to all the relevant company, project, legal, and financial information that is required. Let's move on to the next step, which is the financial modeling. So there's a need to have a deep dive review of the financials to highlight what are the drivers of growth and the cost base and the granularity of understanding the assumptions assist in making the process much easier. So there should be details around specific contracts, the markets you're aiming at, where you're operating and where you aim to operate, and who are your key your key stakeholders within your business. It's important to look at both upside and downside scenarios. Again, when projecting, it's not easy to understand, or it's not guaranteed that a particular outcome will come through. And it's always good to look at both sides of the coin. You then need to outline your company shareholding. What's the current shareholding, and what would your shareholding look like after investment has been put in? And then, of course, build the financial model to understand what the returns would look like at different scenarios, but also different funding levels and instruments. Moving on to deal structuring, it's always important to identify your preferred and acceptable financing mix across debt, equity, and all the others that you have mentioned. And this can be optimized into the financial model to give you a much better picture of how your capital structure will look like going forward, but also how your cash flows would be impacted based on the different types of financing instruments. A typical case we normally see is, or what has always been the case is, and quite common for a lot of family business, is the requirement of picking up debt, not understanding the impact debt could have, and there may be a possibility to understand how an equity injection would then improve the valuation or improve the value of a business and the cash flows going forward. And this is where it comes to. So you need to consider the valuation based on cash flows, the assets, the liabilities, and the market approach that you're going to ideally take on board. Moving on to the next step is the importance of conducting exercise to measure the lender and investor appetites. And this is the engagement with potential investor. And this is where we call market testing. Typically, in this case, a brief 1 or 2 page teaser is generally sent out to various investors that meet the requirements for a particular type of investee. And we'll go through that in other sessions and other webinars just to see how we strategize or how you do an investor mapping to find the right funder or right investor. The next step after that initial market testing is obviously sharing of the non-disclosure agreements. This allows one to discuss the business or the investment in more detail, but also protects the investee company from losing out on any critical information or that is their own proprietary information. Moving on from there is the due diligence process, and how do you manage the due diligence process, and what are the requests from the potential investors? What typical documents can they be looking for? And this can vary. This could be minimal information, but it could be quite intensive and have a very long list of the different types of documentation. And you'll see that towards the end of today's webinar, where we see the various sort of high-level information or that may be required and the importance of that information. Then the next phase is obviously when you're looking at or selecting an investor is understanding your long-term working relationship. How are we going to manage to grow together, create that synergy and add value to our strategy and the culture within the new organization. Moving on to almost the closures and getting to the negotiation phases, there's always the need for priorities with term sheets and facility agreements, and also the sale and purchase agreements. And these need to be negotiated or will likely be negotiated to get the best of both worlds for both investor and investee. And this allows to create a more meaningful marriage between the two parties. And what are you looking at, and what are you typically negotiating over? You're negotiating over the investment amount, how much can be raised. How does the shareholding change? What's the shareholding structure going to look like? You're trying to negotiate on the interest rates and get the best interest rates possible. Limit the number of or limit the fees that may be included in various stages of the transaction raise. And this is a typical case for debt lending, where you'll see a lot of supervision fees, commitment fees, etc. How do you negotiate and limit those sort of costs during your negotiation? Also, agreeing on the length of agreement, you would want, as typically private equity investors have a 5 to 7 year time horizon. Again, that could be shorter depending on the year of their fund operation already, but you'd want them to stay much longer. And there are ways that some PE funds can negotiate with their limited partners to allow them, the GPs, to allow them to basically say, okay, yes, 7 years are exiting, we'll give you another 2 years, let's see how you can turn this business and create more value. Same thing with debt. You're trying to look for the longest period, you're trying to get the biggest moratorium, just allow you to, especially if you're starting a new project, to allow you to generate the sufficient cash flow to cover or to break even on those assets of capital expenditure. But you're also looking at what are the rights, or negotiating on the rights that you'll have, the control over the business, decision making, and obviously how intense would an investor be in terms of making strategic decisions, or would they let the easier items be decided by management and only jump in when they require to have a very serious decision to be made on a particular expansion route or strategy. And you're also looking at the future exit points and expectations of the investor, whether it is at a certain time, but there are also points where if an investor exits, there may be an option for an investor to exit and also reclaim their value. Or it could be a point where an investor exiting, or an investor may not like an investor exiting by selling their stake to, or selling the investor's stake to a different competitor and the likes. And then obviously at the end, you agree with your binding term sheets that will allow you to now get into the final offers. So at execution and close, you're now finalizing the legal documentations. You're looking at how do you look at the operational changes that are going to take place. You need to organize the strategic decisions that you're going to make, the way you're going to move forward. How do you hand over certain duties and responsibilities to an investor on the board that does come on the board, and also hand-holding the investment or the investor through the entire process. So it's very important to always consider the first 100 days plan after an investment takes place, and this helps to gel the synergies. Often deals fail after completion based on the fact that synergies are not met and there's no matching of minds between the investors. So let's move on to the next step, which is what are the basics for companies in the first day, or the first companies that are looking at external investments. And these are companies that have just come on board. This may be their first investments coming on board, and what does one need to be looking out for? So prior to embarking on an investment process, it's important to note that there are certain key elements that need to be in place to help maximize the chance for a successful capital raise. The first one is to have a strong business plan that outlines the key objectives and opportunities with the verifiable financial projections and the detailed growth strategy that a business may have or has in place. Second, investors are also looking for companies with a strong management team across the board. And it's not only the CEO, but also looking at the CFOs and the COO amongst other positions. And we do realize, and Zahir was there with me, we've seen the importance of CFOs becoming more value driven and an assistant to the CEO position. So also having teams with a deep and relevant experience, someone who knows what they're doing, someone has had that experience before within a particular industry, but have also shown the ability that they can work with others and have a commitment to the task at hand in order to grow the business, grow the value, grow the business and value to the point where investors are seeking to take the business. The third point is always to think ahead in terms of the type of investors that would be the best fit in from a value add perspective that they bring in. And this is again where I mentioned a lot of deals do collapse even after successful close because of lack of synergies. There's no best fit. Value addition is limited, and it also allows one to also understand an investor and how they would work alongside other companies, and how would they raise financing. So a lot of investors are also seeking investors who have the ability to get much cheaper financing going forward. If there's a need for capital expansion in the next few years, can a particular investor identify other companies or other financing parties that will allow them to have much cheaper funding going forward, and what are the terms that they would offer for to ensure that the business plan is tailored and the reach and it reaches the outreach is accordingly. The next point to understand is that the due diligence process can be quite lengthy, invasive, and requires serious levels of details and understanding for that process. Being as organized as possible and mentally prepared for this stage is quite important. It's quite a lengthy process. It can vary from a 4-week process to a 3-month process, depending on the complexity of the business, the level of due diligence, or the level of detail that an investor is likely to go in. But it also depends on the size of the business and how many and the operations of the business. Multi-jurisdiction operations can be quite lengthy and quite difficult. Different laws and regulations need to be looked at in a different way. So again, it's important to ensure that one is prepared for that lengthy due diligence process. So going forward, it's also important to understand that investors value transparency and honesty around a particular company's strengths and weaknesses, but also understand or they appreciate the company that understands the challenges that they are going through. It's important to have regular updates or provide regular updates to investors during the fundraising process. So whilst this investment process is going on, there are things that could go right. There are things that might add value, but there are things that could also potentially dilute the value of the business. There could be different legal or different laws that come out that prohibit a certain sector from doing certain things, and having the investor updated on all the different issues that pop up allows the fundraising to be more valued by the counterparty and provides that sort of softer addition from the fundraising perspective. Next, when you're negotiating the deal to maximize the value, it's important to be fair and equitable to all the various stakeholders. Being realistic about the valuations, especially understanding when valuations are overly high, are a general failure point for many deals. So if a business is always assuming, or an investor is assuming that the valuation can always increase, or being unrealistic that the value should be much higher, it's a typical no-go for a lot of investors, and these are where you see a lot of the deals collapse. And throughout our experience, the biggest hurdle in terms of timelines and closing deals is always bridging the gap from a valuation perspective. So let's move on to the next part of our presentation, and this goes to the entire preparation phase. This was a overview guidance on the entire investment process, but now we go into a deep dive of all the different phases of the investment process. So we'll talk about the preparation phase for today's webinar, and then of course we'll give you an update on the next webinars and the topics for that. So let's start by understanding the need to thoroughly prepare for this investment process. A thorough work upfront ensures that the deal will be successful or can be successful, but many deals don't succeed even with a great concept, of opportunity. This is because of the lack of detail and the lack of organized information that is provided to investors. A due diligence is speeded up if all documentation is in place, and there's preparation, and the preparation also demonstrates to investors the readiness and competence of the company when setting up their data rooms. It shows the governance in place. It shows the management capabilities and abilities to ensure that the timelines are reduced and the process does not take too long. A considered strategy and a business narrative with thorough financial analysis is also critical to get a deal over the line. The reason for this is that it ensures a coherent and consistent message backed by justifiable financial analysis that an investor can trust to put their money against. So let's look at the key preparation areas next. And the four key preparation areas that need to be looked at. Let's start with the first one, and that is to know the exact level of funding required. And what do we mean by that? It's important to consider the capital expenditure, the operating expenditure, and the working capital that is required to get a particular project off the ground. So having fair or accurate numbers against a balanced future cash flow is something that is very important to consider when actually identifying the amount required. You also have to take into account the existing performance of the business. How has the business performed so thus far? Is it a business that is showing the likelihood of better returns going forward? Have they managed to meet their goals and budgets throughout the historical period? And how this is done is generally through a detailed financial model. So that allows one to look at the historicals, but also look at the projections based on the consideration required. Next is to have clear and organized documents that are already ready, and this should be legal, corporate, and financial information of the company. But there may be a requirement to consolidate also the financials and the corporate structures. There needs to be a streamlining of all the shareholder structures even before starting the investment process itself. And these are required in an organized manner, easily accessible when required, to allow for to show that the business is definitely prepared well for the investment process. And then you move on to the third stage, which is the creation of marketing material. And the reason for that is if one needs to efficiently engage investors and capture their attention, or what we call bite the bait, it's important to have a brief slide deck or a brief information of the company and the opportunity it presents. But this document needs to also clearly explain how the business model operates, what are the opportunities in the market, what is the business's growth strategy going forward, and what are they looking for. These are key important elements, and this is what we call qualitative information for that investors also take very strictly or give strict importance to as well. And how is this done, or how do you efficiently show or grab attention of investors? Is to create teasers, pitch decks. Teasers are 2-page documents with no names. Pitch decks to provide brief overview and presentations, and the other is the information memorandums. We'll look at this in more details later. Last but not least is the fourth key area, which is identifying a suitable investor for and the type of capital that is required. So it's important we understand the mix of funding that best fits the business and the project going forward. This involves understanding how much debt, how much equity, what's the combination that is required. Is there other options from a mezzanine position, structured finance, and all the other options that we looked at? And this could be something that needs to definitely be considered. You then need to research on the types of investors that are around that provide the various kind of funding, uh, and then from that point of view, you need to understand that what they would be interested in and how they would be interested in funding a particular project or investing into a particular company. And to do this, or to identify what you call the investor mapping, it often includes the support from from a particular transaction advisor that will assist from a deal, from the start to the finish of the deal, uh, and that has a greater network and experience in dealing with different types of funders, understanding the different financial jargon that may be used, but also provides the opportunity for an investor to ensure that the transaction advisor is able to provide them with the best suitable deal. So as I mentioned, investments or the investment process can take long, but there's a way to mitigate this. And the way to do this is to ensure there's a dedicated resource and time is available, because typically a deal process can take anywhere between 6 months, but generally it's a lot more longer, and 18 plus months is a possibility. It could even run into 24 to 30 months as well. And the reason for this dedicated resource, there's a lot of management team will have to do for a deal, to ensure, and that means ensuring that they have enough time and the resource that is set aside, which is very critical. The reasons for this: the investment process is quite intense with lots of analysis and data requests. In addition to project managing many different stakeholders is also another important aspect. A dedicated person internally from the investee side can make all the difference. Whilst we know that the CEO will be key and needs to develop and manage the different stakeholder interactions, a committed resource beyond this is important to free up time for the CEO for the day-to-day running of the business. And basically what this does is it makes the investment process more efficient, speeds up the retrieval of information that is required, and as a dedicated staff to of course explain any questions or any queries that may come about. The best person to do this is a financially literate person who knows the business well, but is also somebody who is senior enough that they can represent the company at different times of the requirement during the process, but is also someone within the business itself. If there is no particular person within the business itself, it might be key to hiring somebody to work or be the priority for this particular transaction or capital raise. Lastly, when a critical thing for a lot of investors is being mentally prepared for the time-intensive process. As I mentioned, it could be 18 plus months, and being prepared mentally is very important. Even with a dedicated person, there's always that much time that is required, but generally we'll see where deals do collapse when someone's not mentally prepared, and the reason for this is called deal fatigue. People get tired of responding when things are not moving quicker. uh, it creates a laxity, and for that reason people are not responsive enough and things slow down, and then that leads to a collapse of the deal. Let's move on to the next slide, which talks about, and something that has become very important for a lot of investors in today's day and age. And this is quite typical for impact investors, for development financial institutions, for foundations, and the concessional funding, or concessional funders. But not only is it important from an investor's point of view, but the strong environmental, social, and governance practices also help improve the company valuations and increase the chance of procuring investments. Let's look at each of these in more detail. So when you're looking at a strong environmental risk management being top priority for many financial investors, the deals then will be considered across two different aspects. So what's the current climate and environmental impacts? What are the environmental risks and benefits of a particular project? Again, if you're starting a new project that involves mining, it's something that could be a negative view for a particular investor. So so you consider the environmental risks and benefits across these various items. So you're looking at it from your products and services. What products and services are you providing, and what's the environmental impact or benefit on that? How do you undertake your production processes? What is happening? How do you mitigate some of the waste, especially from a chemical-based business? How is your waste management processes, etc., done? Is something that will be quite critical. But you're also looking at your buyers and end partners, and also all your other partners, including your supply chain and the raw material that you're using. What is the impact? How does this come? How does this impact your value as a business? If someone across the value chain is also not working in the right way or form. What are your waste management and circularity of the business? Are you able to recycle your particular your waste products, and then obviously create some sort of circular economy within the market you're running it, the market you're operating on? Key question these days has also been on energy sources. You've seen a lot of influence on having renewable energy sources being put in place, but also ensuring that there's efficient energy supply, and of course ensuring the limit on environmental impact. Again, same with transport, logistics, and of course your natural resources and the ecosystem management of the environmental risks and benefits of the project. So the opportunities for improvement, you need to understand the opportunities to improve the carbon footprint and other green aspects of a project that is aligned with the company resources priorities. And this is across energy efficiency, reduction or recycling of waste, local supply, increasing local supply, and ensuring there's greener inputs. And this is something that's going to be quite important when the world moves towards a carbon neutral position. We know that at one point it will be required that businesses across the value chain ensure that their suppliers and buyers are also green from that perspective. So let's move on to now understanding the business and the business planning strategy and preparing of all the documentations that are required. So for the purposes of investment, a business plan is a way in which there's an opportunity that can be articulated. They tend to have 5 basic pieces of information. This could be increased, obviously, but the typical information that is required is the description of the business and the opportunity that is there. Undertake an analysis of the competitive environment and the underlying market that you're operating in. What is your marketing plan, and how do you aim to go to market, especially if there are new products or the others that are already doing a particular product? How do you aim to capture market share? Your key human resources, or what are the additional people that you require? What's the quality and capabilities of these people, especially the key senior management team? And last but not the least is the very key financial information that allows investors to understand the business from a quantitative point of view. So having full internal buy-in across all stakeholders for a particular plan or strategy, there needs to be a consistent message to all investors. For success, it's important that a co-developing and an agreement or to the business plan can be achieved between the investee and the investor. So there's a meeting of minds where both parties are able to agree on a particular business plan going forward. And then going further, the business plan and strategy is information that can be used for more targeted investor outreach materials. So you're looking at marketing materials that are more detailed towards showing this particular strategy and the business plan going forward. So that's understanding the business plan and business strategy. And the business plan and business strategy is important, as that allows us to move on to the next stage, which is to develop a financial model. And having a solid financial model is the base, is a basis for investment decisions. The financial model is a quantitative representation of your business strategy, and how the company expects its financial projections to look like, and gives the investors that gives the investors the detail and the ammunition to fully assess the deal, or the potential of this current opportunity at hand. So what does a financial model do? It basically provides investors with detail of the company's current financial position, but also its future growth potential, including the underlying assumptions that have been used to project future business performance. Secondly, it allows investors to assess the risks and the returns of investing their money, by providing a basis for calculating on their own requirements and their own targeted returns, and would that be possible to be met. And you'll see this quite often with the equity investors, and also with debt investors, where they put in covenants that have to be met, and this projections allow them to understand it from that point of view. It provides key financial details that are also used to negotiate the terms of the investment, including the valuation, how do we structure the business, what's the exit strategy, and also allows investors and the investee to understand what the shareholding structure would look like if investment had been put in, and what are the likely ways of exiting, and the returns that everyone's going to get, and what impact will it have on the capital structure going forward. So what makes a good financial model? So an effective financial model definitely has to show a thorough understanding of the company's or the business model, company's strategic model or business plan, its revenue streams, and the costs have to be thorough enough for an investor to understand the operations of a business. It is essential to ensure that the financial model is accurate and transparent, but also easy to understand. So complicated financial models make the deal a lot more complex, takes a lot more time. Having a more accurate, transparent, and easy to understand model reduces that time and allows for quicker negotiations. It needs to definitely be accompanied with the detailed explanations of the assumptions that you're using, and the calculations which are used in the model. So typically, whoever's created the financial model will need to definitely be able to easily explain it to the investors, so that investors can do their own stress testing on the model, scenario testing. But a clear, concise model also builds trust and confidence with the investors, giving them more realistic figures, projections, allows them to understand that that the management of the company is quite realistic, and understands and understands the business that they're working in, the project that they're looking forward to. And ideally, a model would then include sensitivity analysis that allows someone to change the key assumptions, which would affect the returns. And this is typically a case with a lot of investors, especially debt investors would look at it from a worst case scenario, just to ensure that the cash flows being generated are sufficient. But this sensitivity analysis also provides a means for these investors to create covenants that are required in your final documentation. And a key element and an example is understanding what debt service coverage ratios look like, what does debt equity ratios look like, and the like. So these are things that a lender would look at before they come in and provide a feedback on the terms required. So once you've done your business plan and your financial model, you typically try to understand the valuation of the business. The three typical methods: discounted cash flows, market approach, cost approach. I'm not going to go details on the different types of the valuation models, as that's not typically our main topic concern today. But the valuation of company basically will set out a potential price or value of the business, from which an investor can then make a basis for their bidding process. And this is often provided through a financial model. And we note many deals as I mentioned earlier, we've noted many deals failing due to unrealistic valuation assumptions of the promoters or investees. And something that investors believe is unrealistic will not be willing to meet, to even consider the opportunity if a valuation is provided up, an unrealistic valuation is provided upfront to potential investors. So the most common valuation methodology for African companies or companies in Africa requires a financial model for the deal. And it relies on a volume of data and historic transactions, but these are less applicable. So that's the market approach. That this is less applicable in most manufacturing sectors, especially because there's very limited data available within Africa itself, especially on transactions or previous transactions in the private sector, but also from a public sector, the data is not sufficient enough to allow this. So it's not a very common method used in Africa. Then the cost approach is generally it. Yes, you can look at the business from or what we call a replacement value. How much would it cost now to build the same business? A typical example is an agriculture processing plant of, well, what you say, from agri farm to agri processing. What's the potential cost of building a farm and then building a factory and getting all the assets? It's another example of a valuation method, but it undervalues the future potential and growth of the business. It eliminates the aspect of goodwill or brand image or brand value, operational values, reputational values, etc. And it's an approach typically used for insolvency or and not typically for a business that is looking for growth capital going forward. So typical valuation methods and what they set out on the way to go about it. Once you got the models, you got your understanding of valuation, we'll then look at what are the sort of deal structures that can be taken that can take place. So first of all, deal structuring is the process of getting to the overall investment structure across various elements across the various elements, and each element of this deal structure impacts the terms of the investment itself, the returns that investors will get, and what are the potential risks involved in the particular investment itself. Overall, deal structuring is complex and requires careful consideration of various elements and interests. So it is important to align the goals and interests of all parties that are involved. That includes the investors, the management, the founders, the owners, or the other shareholders and the likes. And this is done through negotiation and discussions. Seeking legal and financial advice to ensure that the terms of the deal are legally sound and financially viable or investable can have a big impact in successfully agreeing a deal and leading it to closure. So typical items that you need to look at a deal structuring is the type of instrument that you're going to be looking at. What financing instrument do you need? What are you going to use those funds for? And what's the time frame that you require for these investments during the investment period, but also during the exit strategy and what you'd be looking at exit strategies. The fourth one is, of course, the valuation of the business. And a lot of these will combine with each other. So valuation of the business can determine the instrument that you should be focusing on. And then also looking at the transaction parameters, the corporate entities that are there within the deal, who's involved, and who is required to be involved within this transaction. And then lastly is, of course, legal agreements, something that's very key to ensure it's gotten right so that the deal structure is solid for both parties or the various parties involved in this transaction process itself. Let's move on a little bit more onto the marketing material itself. And where we see here, we've got two sorts of documents, the teaser and the information memorandum. But the idea for marketing material is to generate interest and give enough detail about the business. Having documents that succinctly outline an investment opportunity, whilst it also provides enough details to understand if the opportunity is a good fit for an investor, is important. As I mentioned, the two types of documentation. The first one is what we call a teaser. Generally, they're not always required, but they provide a 1 or 2 page summary of the key details and metrics of the opportunity so that you can generate the initial interest from potential investors without disclosing too much information, too much of the project plan, too much of any sort of crucial proprietary information for a company. So, and the purpose of these teasers is that you can share them without a non-disclosure agreement, uh, because it does not. You don't have to, or your teasers don't generally disclose any company details to the potential investor, and this allows for to just include high-level descriptions and high-level financial matrices, and possibly key notable achievements of the business itself. Post citing an NDA, an important document, and what we typically see in the market that goes out to investors, uh, that allow investors to now fully understand the business, is the information memorandum, which is a comprehensive document providing the detailed analysis of the opportunity, but also serves as a tool for the due diligence and risk assessment purposes. It generally includes a lot of financial and operational data, market analysis, understanding the market, details on the management team and the profiles, and all other relevant information relating to the business, proposed project plans, a growth strategy in place, and where a business expects to be over the next few years. Looking at a pitch deck, which is a much smaller version of an information memorandum, which covers only key areas with less that compared to an information memorandum. And this is typically to speed up review processes, to start receiving initial offers much quicker, and lead to a quicker route to due diligence process. And typically, a pitch deck would only have about 20 to 30 slides on PowerPoint, rather than a full 100 plus page that you've seen for several information memorandum documentations. So, what does your marketing material typically look like? And what should it contain? These are the key items that an IM or an information memorandum or pitch deck would be looking at. If you start with the summary, the answer, it's an answer to why somebody should be investing into this business or this particular project, and how can someone be sure investors will make a return within the 7 to 9 year time frame. It needs to highlight the opportunities, which are the key strengths and the key messages that you want to put out to the investor. This is so the summary initially brings the first attention from the investor that would want to seek to understand and read the information memorandum further. It also looks at how much. It also talks about how much is required and the time frame it is required at. So it gives an investor the right time to understand: is it something that fits their investment, the investment statements or investment policy statements. The second part of the deck looks at who the team is. So the team leading the project or the business should be having the relevant backgrounds. Typically, you put 2 to 5 people, and this is the key management or senior management. So you typically CEO, CFOs. And it's also outlined the corporate structure and the governance structures of the business itself, and if it's applicable. The next part is looking at the problem. So you need to highlight the challenges that are being solved by the capital raise and the reason you're looking for the capital raise. And it's looking at what's the vision you're trying to solve, or the problem that you're trying to solve by raising this capital. The next part is what you're looking at is what is your solution to those problems. So what are the current and future products that you're working with, or services that you're providing to the market? Do you have any sort of certifications or details of the standards required, production processes that are in place to ensure that those problems are solved? And what are the unique technologies and the unique intellect properties that you have or processes that you have in place? So this first 4 highlights or gives a very significant detail about the business, the requirements, and what you're trying to solve, and obviously details on the team. Now we get into a little bit more detail about the investee itself. So you're looking at the history and what have they achieved so far? What concepts have they already proved? Who are the type of clientele that they deal with? What's the timelines and milestones looking like over from a 2 year, 5 year, 7 year, 10 year period? Which facilities and geographies do you operate in? How's your organization structured? Who are your key employees? Do they fit the profile from not just the capabilities, but also from maintaining the ESG or matching the ESG requirements? And what is your existing business model? What is your unique selling point? So you're looking at it from a pricing and strategy point of view, and of course the sustainability of the business model uh, currently, going forward, and obviously including the new opportunities. The next is looking at the opportunities, and this is looking more from a point of view of the market landscape. How big is the market for your products or services, and the potential to aggregate. If there's a need for diversification, do you diversification horizontally or vertically, or you move into complete different lines. The next is also understanding your specific niches, being the being targets. So who are you going to target? If it's a new product line, new service line, new project, who are you going to be targeting? Is there enough of these markets to support your business? You're also looking at your competitive analysis, but who are your competitors in the market? How do you differ from them? What's your unique selling point compared to your competitors? Next, you're going into your execution for your strategy, your growth strategy. So what details are you going to put into your, or what is the growth strategy that you require from a commercial point of view to take this business to the next step? If it's a new product, new service, how do you envision to acquire customers, and what is the strategy going to be to acquire customers going forward? And what are the type of customers you're going to be looking at, and also the geographies that you'll be looking at as well. But this execution also allows you to then explain how you will break even and get the returns back for investors. So where do you expect the business to start off and end from a particular point of view, and when does investors expect their money back? Going into the future and the potential upside, which may or may not have been considered already, but what are the future areas of growth that you're looking at, future areas of your revenues, if it's not the base case of revenue growth and costs? What are the requirements from a strategic and cost perspective to develop the upside potential further? Impact is another key element, and it's quite important from impact investors and DFIs that are looking at the development that a particular investment will create going forward. And this is quite relevant from an ESG perspective, as mentioned earlier. So you're looking at the climate impact, you're looking at social impact from job creation, employment, but creating sustainable technical capabilities within the region, trying to create an inclusive economic transformation within the geographies you're operating in, but also improving the livelihoods of other people, and obviously from not just from the poor perspective, but also from a gender perspective as well. Lastly is now second lastly is where you now put in the numbers, which is your financials. So you're looking at your historicals and your projections for this. It could go up to, you could have a full statement, you could go up to only EBITDA level, show your cash flows, your balance sheets from historical to projected point of view. And what this does is basically provides an evidence to the story you've just said earlier in the earlier sections, and allows one to understand that the business, yes, is on a growth path, or it understands or allows an investor to know what stage of the business cycle a particular business is at, and where does it aim to reach. Then the last bit and what's remaining is, of course, the ask. This is the amount you're looking for in more details, the type of instruments you're looking for, at what time or phases of the next few years are you looking at different sort of funding requirements, and of course allows you to then have a more detailed plan of how your business is likely to operate. So once you've got your marketing material, the next one is, of course, shortlisting your investors. And this typically involves researching the potential investors who may be interested in funding a particular business or project, and aligning those who would be the best fit for the particular investment, and are already active at the present time in terms of providing capital. In creating an investor list, it's worth considering the following points. Firstly, whether the fund, especially from a private equity or a venture fund, DFIs as well, there is multiple funds that are supported by or that are headed by DFIs, but they have different funds for different prospects at different times during the horizon. So it's important to understand whether the fund is still actively investing, or are they holding, or is the fund at the point of looking to exit its investment and provide its funds back because the time horizon is almost over, is a key item. You also need to consider the countries there and the sectors that they're investing in. Typically, investors will have an investment policy statement that allows them to only invest in certain geographies, certain sectors, give them only a certain type of investment that they could provide, and this is what you call the investment criteria that they are going to be looking at. So what's the typical size of investment do they put in? Not everyone will give you the full amount. Some look at providing funds below a certain ticket size. So, and we group this up into venture, small cap, large, mid cap, and large cap. And you'll have different funds and different investors providing different ticket sizes. The next is what value can they add to your business in terms of industry, in terms of the industry experience they have they invested in similar businesses before? What is the success rate of those investments? What is the success rate of the business itself, and did this investment show growth previously, is something important. But also understand that they're not invested in a company that's competing with you directly as well already. You need to understand that they do have access to networks, so financial networks, strategic networks, people with expertise, and are able to bring these on board during the investment cycle and the investment phase. You need to clearly understand what their strategy and culture is, and it has to align with your business and your particular business culture and strategy as well. Based on this, you create a long list of investors, and typical process is to create a long list of investors, and you shorten this by basically looking at the ones you typically know are the right fit, and these are the ones that will be given priority over the investment opportunity before it is expanded even further. So, and you base the assessment on who you'll pick based on the fit with the business and the level of interest that they show. But also, it's important to understand the matching of minds, because these investors will also be sitting on your board as directors, driving or guiding in the strategy, and it's not something that you want to be in conflict with all the time, limiting your business upside potential. And if you identify the characteristics of the different types of investors, it also assists to tailor your approach to them, and what message would you give them, right? If you're going to a DFI who is looking at development impact, a key message would be on a development point of view. If you're going to a private equity investor, you're looking at growth. You're looking at them increasing the value of the investment. So how are you going to deliver? So you need to tailor your message for each particular investor based on their characteristics and what they're actually looking for. If you're looking for, if it's the foundational funding that you're looking for, which is concessional, the idea is typically for impact. If you go to a bank or a typical lender, it's cash flows that they're looking at. So you need to tailor your message in your IMs and your pitch decks to what will drive interest from those particular investors. It can be advisable to have a long list of investors if possible, and you need to keep them a lot more diverse so that you can approach different parties to increase the chance of one closing the deal with you going forward. So you've now sorted a list out of potential investors. The next step is ensuring that you start preparing for your due diligence. There are quite a lot of things that will be looked at. This is a limited list of some of the things that potential investors are going to be looking at. but they do conduct comprehensive review of the business before they even decide to make an investment, or the investment committee decides to give a go ahead. Uh, as I mentioned earlier, it's a comprehensive process, but it can be time consuming process to ensure that the analysis that they do behind an investment or behind a particular investment makes sense to them, and it providing them the right value for their money. And it may require that they find some red flags, and they might require you to go much. They might want to go much deeper in understanding a particular concept, context, or a risk, or any potential liability, contingent liabilities, as we call it. And so this can again make it more longer. And it's always good to have relevant sets of documentation that cover most of these issues. It's not always a bad thing, even if there's a red flag, as long as there's a risk management strategy in place that shows that this can be covered, the risk can be covered, is always good, and it's always good to show us information on that. So what are the typical types of due diligence that take place generally? So you typically have your financial, legal, and tax due diligences. We can combine financial and tax together, but you'll have certain companies that will also, certain funders that will also do commercial due diligence, especially if the project is quite new. Or you're getting into a new product line or a new service line, they'll definitely do a commercial due diligence to understand the market out there. They may also do an operational due diligence to understand your full processes as well. And if you look at it from a technical perspective, and this is quite typical for project finance, an example for a renewable energy project of large scale, they're going to do a technical due diligence to ensure that a particular technology actually works for this, and there's an appetite for that, and who are the right technical teams that are employed, and are they capable of doing it. So these are several types of due diligences, but typically in our from a business perspective in East Africa, you're looking at a financial and legal. Yes, at times commercial will kick in, but these are the typical type of due diligence. And it is crucial in identifying what are the potential issues, assessing all the risk that may be involved, but it allows the investor to make a more informed decision so that they can avoid any financial losses or missed opportunities. It could be a case that a due diligence may show that there is strategic alignment to be had, and that creates synergies with other potential investments of theirs, and it could be something that allows them to grow further. So during a typical due diligence phase, the investor is going to typically hire specialist advisors, just so that they can quickly, or the turnaround of the analysis can be quicker, and the due diligence process made shorter, so that the deal process improves, but also prevents the idea of deal fatigue during due diligence. And based on this, investors will generally prefer not to invest if they find any doubts or uncertainties that are raised through this due diligence process, because all investors, given majority of them are looking for return back, are generally seen typically to be risk averse, especially from alternative investment perspectives, and of course private businesses are alternative investments, and for that reason there's much higher risk, and they generally tend to be risk averse. Again, these are things that are said in the investment policy statement that is being set by the initial investors, especially for private equity funds, and they allow a no-go. So the certain criteria, as you'll also notice, where certain funds will not invest into various types of businesses, typically tobacco, alcohol, and gambling. But you'll see people not also investing in mining industries or other carbon emitting industries, and all this will be captured into the due diligence, because they'll understand the processes that are involved of a particular business or project. So consideration should always also be given to tax due diligence, with clear positions and strategies for the various tax issues that may appear from the previous company or the investing company, but also from the newly formed or newly invested company. And we have noted a number of deals that have not succeeded due to tax issues, and typically the investee not being prepared for these to resolve these issues after the investor comes in, or when the investor takes a due diligence. if an investor does find a tax issue or consideration, they will definitely put a condition that these need to be resolved before the transaction closes, and these are important things that need to be looked into. So yes, you're preparing for due diligence, but where do you put your data that is easily provided to the various investors? And this is what we call a typical data room. Generally, yes, advisors would keep it, but now we've seen advisors actually manage virtual data room, making it easier for people to provide access to different investors, but also create firewalls where investors do not see each other, and so multiple investors can do the due diligence simultaneously, rather than elongating the process by moving from one investor to the next. But it also allows one to manage and understand, or actually analyze and review what investors are actually looking towards, so you can tailor further information according to that. As you can see on the screen, these are typical folders and what's required, and obviously the priority for them being involved in the data room. But again, this is a limited list, and it could be much bigger. But this provides a one-stop organized place where investors can find all the required information that is required to complete a deal. So if you have a well-organized and easily accessible data room, the deal closure with the investor becomes a lot more easier. And creating a thorough data room is also more beneficial to a particular deal. And it provides a secure location where companies then store and share information or sensitive documents with different parties. Obviously, there's the non-disclosure agreements have been signed already, but it allows for easy, secure way of exchanging information. So the key components of a data room, so it's your financial statements and projections, legal documents such as your title deeds, your leases, articles of incorporation, your contracts with customers and suppliers, your customer and market analysis, organizational structures and the team information that you have, so employee details, who's the important staff, what does the salaries look like, what are the retirement benefit obligations that are in place, and then that's the typical sort of information. There's a lot more, but how do you prepare for your data room? You need to put together all the relevant documents of the company and the deal, and organize them in a more logical manner that is easily accessible to investors, so they're easily able to find it out. Typically, you'll always give them a checklist to show where a particular item is, and sometimes it's investors will provide a list on how they'd want it organized. It's important to ensure that all your documents are up to date and accurate, but you also need you also need to review any of the documents and edit the documents if they're not easy to understand. There may be cases where you may not be able to disclose quite a few things, so you might need to use some redacted versions, or you might have to redact some of the documents yourself. But there's things that you'll need to consider. So how do you manage access to your data room? Typically, you'll have a project manager. Typically, it's your transaction advisor will have the control to the data room, because all communication flows through him or her, and they typically have the access and management of the access. So they will determine who they give what part of the data room access to which type of investor, which type of due diligence team. Typically, they will not mix the legal and financial teams together. So legal will have separate access, and financial would have a separate access. And it's important for this person to ensure that they keep tracking who's accessing the data, what has been retrieved, what has been downloaded, and understand where the focus of an investor is. As I mentioned, it's worth considering virtual data room providers, because they ensure security, easy management for users. Some already have solid folder structures in place that allow you to easily put in documentations based on what is required, and it's more easier to use. And typically, they keep this data on the cloud, but it's not accessible to anyone. But you can reapply for virtual data room again and have the same information on it. And then, of course, allows different levels of information to be shared with different types of people and different investors. So that is the end of the preparation phase. I will hand over to Zahir and Meha. Thank you very much.
Thank you, Sajjan and Zahir, for a very engaging webinar and for the valuable insights, practical strategies, and actionable advice to navigate the complexities of field process and preparation phase. And thank you all for attending. I know we did go over time, so we might not have that much time for questions. So those of you who have other commitments, feel free to leave while we answer Nick's questions. And before you leave, I just want to mention we do have a webinar tomorrow on tax. I'm sure you have the link in your email. And if you can't find the link, it should be on our LinkedIn page as well. And obviously, as I mentioned, the recording of this webinar will be on YouTube. So thank you all for joining. And Sajjan, if you want to quickly answer Nick's question on, are there common virtual data rooms that you can recommend?
Yes, Nick. There are quite a lot of them now. We do have quite a few of them based here in Kenya itself. The ones that we generally typically use or recommend is either Intralinks or Ideals. But there are very many virtual data room providers now globally available. Intralinks operates out of South Africa, but again, given the global nature of world and technology, you're easily able to access service providers from different countries as well.
Thank you, Sajjan. I guess we can wrap up and hope to see you all next year for the next two webinars for the corporate finance series. Thank you. Thank you all for your feedback. Hope to see you next year.